Welcome to my new video in a latest series where I'm going to look at recommendations from other YouTubers and let you know my thoughts on those companies as well. Now, please do not misunderstand. Anything negative in this video or any of the other videos in this series is not meant as a criticism of the other YouTubers or their analysis of the companies. This is simply my views, what I think is important, and what I think that they may have either missed or they've not thought is important enough to mention. And the idea is that I'm going to come back to these at the end of the year, look at the recommendations from these various YouTubers, compare them to my own, and use it for my own learning on whether I've been more successful, whether I've done better, or whether I have anything to learn from them. Now, this first video is called These 3 Stocks Are Set to Explode in 2021, and it's hosted by these guys.
Welcome to MoneyUnshackled.com, the investment and finance channel and website that says you and your finance is free.
That was Andy and I'm Ben.
So let's have a look at what they're suggesting.
The first stock that I bought was Dart, the travel company that owns Jet2.
Well, the guys did really well on this one.
I bought in recently when the share price was 667 pence.
Well, this was filmed back in September, and in November, Jet2 did a trading update and their share price spiked really high. And the price is currently fluctuating between 13 and 1500. So it's well in excess of 100% gain for these guys. But let's see what they're saying about the business.
Let's look forward to where this stock is going.
We've got to be careful here that we're not trying to catch a falling knife, but the fundamentals of the company are solid. For one, the other UK airlines are strapped for cash.
I absolutely agree with that, and if you have a look, a lot of the airlines have received bailouts or borrowed more money since this video was released. So even since these guys did that, more money has been borrowed by these airlines. And that looks set to continue going forward as well.
With loads of debt, while Jet2 is cash rich and is probably the least likely airline to die from COVID. It can easily survive the foreseeable future with reduced revenues now because of that cash buffer.
Now, the issue is that cash buffer is actually melting away. And it's only going to last for so long. And it also could badly slow growth for the business after the pandemic ends. So we just have to hope that they don't burn through that cash too quickly.
Before COVID, its revenue increased massively in each of the last 5 years, and its earnings per share have been creeping up too, 2020 excluded of course.
We even saw massive annual dividend increases every year up until 2020, when it had to cut them when the travel industry was forced to close down.
So the guys have highlighted here how the business has been very successful before the pandemic, and they are assuming that it will continue to do so after the pandemic. And this might not actually be the case. It may be able to massively grow market share from other airlines that have gone bust. But at the same time, the overall market may actually be much smaller. And it could remain much smaller for a long time. So we do have to kind of bear those two things in mind to really kind of estimate the future capacity of the airline market and whether it's really going to be as big as it was pre-pandemic right away.
We feel the share price is reflecting more of the current situation than the long-term outlook. And the current situation is bleak, while the long-term prospects are fantastic. Let's not forget that now that their big competitor Thomas Cook has left the scene, when things get back to normality, there is a big gaping hole for Jet2 to fill. Just look at what happened here when Thomas Cook went bust. Jet2 have not yet had the time to capitalise on this. If we take some fairly cautious assumptions, like that people will be desperate to go on holiday again in 2021, then this stock has the potential to explode in a good way.
All it would take is for flight schedules to return to something close to normal, and this stock could easily return to its pre-COVID heights of 1900 pence.
So they're saying about it coming back to 1900, but this was back when it was 667. I wonder what they're doing now that the price, when it hit 1500. I wonder if they sold it or if they're still holding it. Maybe they're going to wait for it to climb to 1900.
It has loads of cash, a track record of expansion, great reputation, dominance of the UK to Europe flight corridors, and let's face it, as soon as Boris tells us that we're allowed to go on holiday again without the risk of house arrest, everyone who couldn't enjoy a break in 2020 will be rushing to book their flights for 2021.
So my concern is that the market's still very much in denial about the lockdown. For me, I'm seeing the lockdown lasting a lot longer than maybe the market seems to be pricing in, which is going to continue to hurt this company and put it into more debt. And while I completely agree with the guys that post-pandemic, this company is going to be one of the survivors and it's going to be one of the champions coming out of the pandemic, it really does depend on that market size that they're going into and what condition the business will be in by the time the pandemic kind of starts to lift. And that's really going to end up weighing on the share price. Now, on the flip side of this, if the pandemic kind of lifts and lockdown restrictions start to ease and people start to travel faster, sooner, then there's a good chance that this share price could suddenly rocket very, very quickly. And even at its current price, it could still jump another 50 to 60%. So the guys did really, really well getting in at 667 for this stock. But I would absolutely not buy it right now at this price. It's way too much of a risk for me. So let's take a look at their second stock.
Next on the buy list is ITV.
Interesting choice.
Yes, that's right, the clunky old TV network offering an obsolete product of scheduled broadcasted programming. As a concept, its product belongs in the dark ages alongside MySpace and Tamagotchi.
So I agree with this about their main business model. But what about BritBox and ITV Hub?
And yet, there is something too good to ignore about the ITV share price right now. Its 5-year chart is a story of decline, as its perceived future potential gradually declined to reach parity in 2019, with some estimates of what its underlying assets are worth, which some argue is around 130p a share.
But then 2020 hit, along with COVID-19, and ITV's revenue started to dry up. When a crisis happens, the first thing companies cut are their advertising budgets. And ITV makes its money through companies paying to advertise their products on its shows. The share price has taken a hammering down to where it is at now, 62 pence. Too low. I bought in at 60 pence.
Absolutely, I want to commend the guys on this because the price is now hovering at around 105 to 110 pence per share. So they've done really, really well on this.
Its debt is only 2.5 times operating profits, which is outside the danger zone. Anything above 3 would start raising concerns. And on August 27th, Goldman Sachs bought significant holdings in ITV, reflecting the bargain nature of the stock. A massive vote of confidence in an otherwise whirlwind of negativity surrounding the broadcaster.
We understand why many investors are downbeat about ITV. The model is dinosauric in its ancientness, and COVID has limited its ability to create fresh content and cash in from advertisers.
Now, I'm a little bit confused about the direction the guys are going in here, because ITV has been creating content, and with the BritBox direct-to-consumer model, they are less reliant on that advertising. Although that reliance is still very heavy in the business, they are moving away from it. So it confuses me that the guys are pushing quite heavily that the business is out of date. Don't get me wrong, I'm not saying that it's an up-to-date business, but I'm not really sure it's quite the dinosaur that they're making it out to be.
ITV's market cap is currently £2.5 billion, but its true value is hidden in its studios, its people, and its ownership of popular content. Experts place the value of these at around £5 billion if it were bought out.
It's easy to forget just how far the share price has fallen in the last year. At the start of January, ITV had a market cap of £6.4 billion. More in line with reality. Its share price has now plummeted well below what its underlying assets are probably worth.
Failing TV and media companies are bought up all the time by more successful ones. Entertainment One, owners of kids' favourite Peppa Pig, was taken over this year by Hasbro for £2.9 billion, which was 15 times annual cash profits.
ITV's cash profits now hover around the 500 to 600 million mark, and a 15 times markup would value the company at around £7.5 billion. We're not saying ITV has anything as genius and captivating as Peppa Pig, but its current share price is nowhere near this valuation.
While I think that 15 times earnings is a little bit steep, I think the valuation of the content at 5 billion is probably a bit closer to the value of the business. So, in fairness, between that 2.5, 7.5 valuation, right in the middle at 5, sounds about right to me.
However you value this company, it looks like it's deep into bargain territory.
ITV is a big fish in an ever-decreasing pond. The onslaught of on-demand TV from Netflix to YouTube will one day mean ITV's current business model will be dead in the water.
So, as I said before, I agree with the guys about the fact that the old TV model is going to be dead. It's on its way out, but it does seem like the business is moving in the right direction here.
It's certainly not right to value the company at under half its probable underlying value, as the current share price is suggesting.
We've seen this before with tobacco and paper books, in industries written off as dead only to linger on for another few decades. Once COVID passes, filming will start up again, and advertisers wanting to sell products to the over 45s, to the age group with all the disposable cash, will once again pay to be on ITV.
So I absolutely agree with the guys that the company does seem to have been very undervalued back in September, which was obviously when they made this video. And I still think it is actually now, technically, even its current price. However, that being said, I don't think it's actually that far off its true value. So for me, it's probably not quite one that I'd consider buying just because of the risk aspect.
My strategy for this stock is not to hold it long term. I plan to capitalise on it as it returns to something resembling sensible, hopefully doubling my money, and at that point I will sell. What I'm really hoping for is a buyout. If Netflix or Prime or some other company were to buy out ITV and strip it for parts, then its purchase price should be well above what its current market value is. Failing that, I'd hope that the price would rise back to parity once the economy settles back into a normal rhythm.
I think that was a very reasonable assumption to make, and I think it still stands true today.
ITV is going to die one day, unless it fundamentally adapts to a changing world. So once I've made some respectable gains, it will be sell, sell, sell.
Wow, so some harsh times for ITV there. I think they've been very critical, despite the fact that they think it's going to do very well for them. Now, one thing that they seem to have repeatedly said is that the company is not moving forward in the right direction, that it's not moving with the times. And I really do kind of feel like they've missed the online element of the business here. I think that they've kind of missed the whole value of the company. They seem to kind of reference the value of the company in the fact that they think someone else buying it out would work, but they don't seem to see the value of the company making the content and then selling it. So I'm a bit conflicted there with regards to how they're kind of valuing here. So my opinion really is that in some respects that they're wrong about this being a short-term play. Now obviously, yeah, the share price did jump up very quickly in the short term, but the way that they're talking is that they're going to kind of hold it, let the price climb, and then jump out because they think it's going to tank. And I don't think that's going to be the case. I don't think it is going to tank. I think it's going to either sit where it is or slowly climb. Maybe hover up and down a little bit. But the way I see it is the company is moving forward in the right direction. Now, at the end of the day, it's not Netflix, it's not Disney, it's not AMC even. You know, the level of content that ITV has and makes is never going to be, you know, this huge global massive company in global aspects, in global regard. Now, we've got BritBox, which, if you don't already know, is a partnership between ITV and BBC, and they have over 1 million subscribers already in the US, which, you know, obviously, like I say, it's not a Netflix or Disney standard, but it's still quite respectable, all right, and they are growing it very nicely, so there's definitely a lot of positive elements there coming through from the business. And if ITV does continue to move forward in this direction, I do believe that it's going to continue to create interesting content that people are going to want to watch. And the advantage of using the internet and having this online streaming service, it means that they don't actually need to retain that same market size in the UK. So if they make that content and it goes online rather than going through its TV channel, its costs remain the same, yet being able to manage that kind of global audience and having, you know, 1 million customers over here and 1 million customers over there means that they can still get that revenue and it's a much lower cost than having to kind of sell that program out. And if there's not enough of an audience in this country for this program, not being able to find a channel to buy it, it doesn't matter. They can still make the content and they can make the most money possible from it. So long term, it's going to have lower costs for them and higher returns. So going forward, BritBox I think is going to be where ITV is going to end up going. And if BritBox itself doesn't end up panning out, I think there's a good chance that they will end up being like a third-party content maker that sells their content out to Netflix, Disney, whoever else. Probably not Disney, but you know what I mean. So personally, I wouldn't invest in ITV. For me, I don't see enough growth potential in the company, but at the same time, I also don't see this crash and burn element that the guys seem to be thinking is going to happen. So their next choice.
The third stock is Stock Spirits, a UK company that sells vodkas and other spirits in Eastern Europe to mostly Poland and the Czech Republic. We would never have heard of this company except that it came up on a Stockopedia screener that we'd set up to fish for stocks with specific growth characteristics.
Now, I'd never heard of this company either, but that's not really a surprise because it looks like the only link this company has to the UK is that the people who bought the company out are based in the UK. So its HQ is in the UK, but everything else is in the EU. And it's listed on the UK Stock Exchange, but it's also listed in, I think it's the Prague Stock Exchange as well.
This is a stock with great fundamentals, a low PE ratio relative to its industry at 11.4, a growing earnings per share, a growing dividend with a 3.7% yield, low net debt being a 1-to-1 ratio against cash profit, and it's buying up other companies, including an expansion in Italy. It's a hidden gem with a market cap of just £451 million. That's just 11 times cash profits and doesn't factor in the great potential that I see for this company going forwards.
This is a really good growth company and it definitely ticks all the boxes that I would normally be looking for.
Lockdowns, however, have meant that the pubs and restaurants that would normally sell their products in Eastern Europe have been closed to the public, but it hasn't stopped them.
They had a first half earnings spike because everyone was hoarding essentials, which apparently in Poland includes vodka. They've also expanded their product line to produce hand sanitizer during COVID, and the world is now emerging from general lockdowns.
And that's another great point here. The fact that they're making hand sanitizer is a brilliant kind of extra thing that they're able to do because of the fact that if for any reason their factories are not at full capacity with the drinks, they can simply make some extra hand sanitizer. And at the moment, I think the demand for hand sanitizer is just ridiculous. So I don't think they'd have any problem shifting that. So definitely a great extra kind of way of boosting their income and keeping that factory floor moving.
I bought into this stock at 221 pence. The price has only moved a little since time of filming, so it's still as good of a time to buy.
So the price hasn't really moved much since then either. It was at 221 pence in September, and it's been slowest grower of all three of these stocks. And it's only up to 286 pence, which in normal times would be great growth. However, the last few months can be hardly normal times, can they? Especially in the stock market where so many stocks have been growing by 100% in that same time period. So the guys have still made some really good returns on this one, even though it's not the best performing.
My thinking with this stock is there is nothing holding it back. It has survived the worst that the world can throw at it, adapted, continued to expand, and kept its fundamental numbers tight over the years. Unlike ITV, I'd look to hold Stock Spirits in my portfolio longer term. It has a lot of growth potential, and there's no reason why this stock shouldn't explode in 2021 once the dust has settled from the madness of 2020.
Now, I completely agree with the guys here on this company because this is a really great company, and I actually think out of the three that they've recommended that this is, even though it's been the lowest returner for them, I actually think it's the best investment because for me, regardless of what happens in the global pandemic, this business is going to boom. It has a great business model and it uses its available equity to make acquisitions and constantly expand the business. is growing its dominance in the industry. And as the guys have pointed out, despite Brexit, it's not going to make any impact on this business, which for a UK listed company is quite rare, but really great news. And if you look at the countries that this company operates in, we're talking about Poland, Czech Republic and Slovakia. And those three countries are really, really fast growing countries within the EU compared to the rest of the EU. So the fact that these businesses are growing through acquisitions within growing markets is a real tick in the box for this company. And when you're looking at the expansion, obviously they have the whole of the EU to expand into. The single market is fantastic opportunity for this business to continue growing, and the fact that it's already making great gains in Germany, which is the biggest economy in the EU as it is. So fantastic opportunities here, and their consistent year-on-year growth and profitability. I mean, we're talking about a brilliant opportunity for this business. Now, this stock is not on eToro, so I can't actually add it to my portfolio. However, that being said, even if it was on eToro, I wouldn't be adding it anyway. Because for me, from its current price, I don't see it climbing any more than, say, 30 to 40% this year. Which, as I've said before, that's still great gains. You know, many people would be very happy with that. But as you know, I tend to focus purely on businesses that I am really, really confident are going to have much, much bigger growth than that over the 1 year period. So that's why I personally wouldn't be investing in this business. But I'm absolutely not saying that it's a bad investment. I think this is a great business. So that's my thoughts on these stocks. By all means, you should check out the full video from these guys, because there's far more packed into that video than the short clips that I've included here. And I'll make sure to include a link at the end of this video for you to have a look. You should also check out their channel, as they've got a lot of great videos on the broad range of finance, not just the stock market. So the channel is definitely worth a look. I hope you've enjoyed this video. If you have, please make sure to give us a like and make sure to subscribe to catch more videos like this. Thanks for watching, and I'll see you in the next video.